Hi, everybody. It's Mark here at Tesla, and yes, indeed, we did close in the red again today. I think I said that now for 6 days in a row, maybe even verbatim. So today's closing price is $215.49. That was a share price decline of $3.73, or 1.7% from yesterday. Now, I would say, before we get too sad about the action, and of course, we always want the stock price to be going up. I would say that today's price action was really determined by options, the flow of the options, the interest at certain strike prices for calls and puts. And if we kind of zoom in on our price action and kind of look at where we started the day, gapping down, and that's kind of Tesla style. We're just going to gap down, maybe get bought back up. But for now, gapping down is kind of the modus operandi. And as you saw, it's 5 o'clock Pacific time, so the after hours trading did close, but you did see it at $218.70 something cents, which is over $3 above the closing price for Tesla. So that's actually really comforting to see, because most of the time, after hours pricing for Tesla is actually setting up for the gap down for the next day, and that price is lower than the closing price. So today, the price was higher than the closing price, and that might be the first time I saw that in quite some time. Okay, but let's look at the gap down. So the gap down was around $217.50, and that's not coincidental. That's exactly how the market kind of set it up to be, because they know if you're watching the options, the amount of open interest and the volume on the 217.50 strike call, that call was getting a lot of interest throughout the entire day, along with what? The $215 put. And so, number one, the $215 put, of course, did not get paid, because it's, as you're seeing, the closing price is $215.42. The amount of puts that were being bought at that strike were in the hundreds of thousands. And I mean, the overall open interest, the overall volume of Tesla calls really it rivals the SPY. But of course, really what drives the price overall for the market today is the SPX calls, which is really what determines when the OpEx is going to be for the month. So today's OpEx, option expiration day for the SPX. And the SPX has two expiries today, the AM and the PM. So you can see price really be kind of violent in the pre-market to kind of set up how the market wants to affect those options, and then thus the price action for the rest of the day could be wildly different. But the $217 call, of course, didn't get paid out, and if you were really familiar with how the price trades on OpEx, you would know that they're recognizing that the 217 call just isn't going to get paid, so you wouldn't have to get too bullish unless you were playing this bottom around 212 that got bought up to 216.81 cents. It was a very considerable move, I believe 2% intraday. So that could have been a nice trade if anyone wanted to get that. That would have been right above our little green box at 212. And so if you're watching that and wanting to play little day trade action, that was really your only play for Tesla. There is other good plays out there, like the Nvidia and the QQQ had some decent runs. But overall, stocks kind of bottom in the morning, got bought back up a little bit as the day went on. But Tesla was actually making lower lows through the day and didn't close above the opening price of $217.50. But like I said, though, I didn't really feel too bad about it, because this is just Friday, and this is OpEx Friday. This is Tesla gapping down on a Friday, so it doesn't you can't really set your expectations too high. And like I said yesterday as well, you really want to watch those options, like watch the options chain to understand should you stay hedged and things like that. And I say hedge basically to the end of the day, and I close my hedges. I won't actually hedge. I'm saying this, and I could regret it. And if something happens over the weekend that is like some black swan event, you can talk to me about it and be like, you effed up, Mark. You didn't hedge. Well, I've been hedged for 3 weeks now, so I close my hedges out, and I don't really like to hedge over the weekend too much, anyways, because it takes a big move to make it worthwhile on Monday, something like 1% or more in a drop to even just break even. So that gives me kind of a leeway that, so if it opens flat, I'll be down hundreds of dollars. So I have to kind of keep that in mind, that I need to judge. but it brings up the question I even asked myself today and last night. Are we near a bottom? Is today then the bottom? And I think we kind of need to look at some historical price action to understand, look, we found some buying today, got some buying after hours today. We've been sold for weeks now, for weeks. So before we dive too much deeper into the price action, let's just familiarize yourself with kind of the historical movement of Tesla stock in these retracements or in these downtrends or these crashes. And we'll do that by switching over to the browser. I made some tweets about this yesterday. So this tweet you're seeing here has a pullback of 26.6%, but that was from yesterday. Now it's like 28%. So 28% is a pretty considerable number. We're talking about over 1/4 of your value of your whatever you're holding of Tesla it's gone within 3 weeks. And it's not a fun time. And we'll kind of compare it to some other pullbacks, and you can kind of see, you start asking yourself questions like, why did this happen? Like, why did we crash in the first place? And I don't know if crash is the right word, but I think it kind of is, in the sense that, it was relentless and there was no bounces at all. Okay, so looking at the tweet, you can see here on the screen, it's some pullbacks. And these are pullbacks measured from an intraday high, not a closing price, an intraday high to an intraday low before the bounce occurs. And we're at 29%, 28%. But you're seeing how, what's below that and mark the bottom. And you have a 24% on March of this year. And you have, this is maybe similar for a pullback. You have this in August of 20 at 20% before you see the pull. Oops, let's change the colors. And a 25% on October in a long time ago. I don't know why I keep doing that. In 2014. So today's this pullback for this month and the last couple of weeks, really, it could be almost considered a historical pullback now. We're talking almost 30%. And on this list of notable pullbacks, there's only 4 drawdowns that are smaller than what we've experienced. And some of these drawdowns actually took longer to develop than ours, because ours is basically a straight down for 3 weeks, and there was no bounces really. There was a couple green days, but maybe only one decent green day out of like 20 something trading days. So we have a considerable pullback already. Now, can it go more? Yes. As you can see, it was more volatile many years ago, over 3 years ago, where pullbacks were like, wiping out half the value of the stock. And even the drawdown from last year to this year was very, very considerable due to, the selling of Twitter and such. The drawdowns were pretty severe. So we've had some pretty bad pullbacks. And this one could, technically it could be more of a pullback. And it's, even though it sounds like a big number, 29%, I guess it's really not that big compared to even some recent drawdowns on the stock. Now, there was another measure to kind of indicate if something is oversold, and I put together kind of a list of notable RSI, relative strength index readings for some of the bottoms that were very, very oversold, because there was some bottoming of the stock that, because it kind of was drawn out or happened too quickly, that it doesn't register much of a low RSI. So the RSI for yesterday was 28.82. So after Thursday's close, and today it is 27.7, I believe. Let me double check for you guys. Let me switch over to the daily. 27.4 for today's after today's action. So we're getting pretty oversold. Now, a lot of people would think something below 30 is pretty oversold. And let's actually look at that. So a 27.8 would mean, well, in December, it was much, much lower. In October, after the whole selling for Twitter thing, it was lower. But some of the others in 2022 and 2021, 27 could be rather comparable or even less than. And in March 20, we have a 24.28, a 20 in June 19. But these older RSI readings from like the 19 and 2016, I don't know if that's really as relevant, but we do understand, yeah, it's low and it's below 30. That's kind of, in my mind, where that is interesting to me to add. That it's interesting to me to soon call a bottom, but then you get kind of humble and you can understand that, yeah, I mean, even the two recent drawdowns from last year, the most recent ones, were around 16, around 24 and a half. So that is, there could be, even on a best case scenario, if October is the best case scenario for our drawdown now, that's about another 2 days of a decent sized pullback in the stock. And 16 on the RSI would mean something drastically bad happened over the weekend or later on this week. And we'll talk about in a couple seconds about some events that are happening next week. So even though, yeah, we're pretty oversold, it could go lower. The RSI could go lower, meaning the stock could go lower. And yeah, we've drawn down 28, 29%, but we've seen evidence that could be pretty reasonable compared to other pullbacks that Tesla has experienced. So are we at a bottom? I think we're of course probably closer to one than not. That could be pretty that could be pretty obvious to say, but we just have to be really careful going into what could be a very volatile week depending on what's happening this weekend. So let's look at the economic calendar for next week so we can kind of brush ourselves up on what's going to happen. So Monday, nothing scheduled. Tuesday, existing home sales. Wednesday, PMI could affect the price in the morning, but since it's going to report at 9:45 a.m., you can have time to possibly hedge yourself here without having to worry about dipping into the futures market to try to get a hedge in or buying some puts beforehand. Thursday is going to be the big day, guys. This is when the whole this whole Jackson Hole event starts up, and you'll have a speech at Jackson Hole from Powell, Fed President Powell, on the Friday, August 25th at 10:05 a.m., which will be after the UMich consumer sentiment reading for August. Now, I think we all have PTSD from Jackson Hole of last year. I remember talking to people, and Jackson Hole was never really something that was too important when it came to economic events. But I think what's going to happen is people are going to go into Friday. And the good thing about it being on Friday, you can buy very cheap puts on Thursday for Friday if you feel you need to hedge, because it's 1 day expiration. And if it's going to be violent, it will sell off pretty hard. So you will have that cover. But at the same time, the market knows people will be hedging going into this event, and they'll do everything they can to still try to make money. But if you were there for Jackson Hole of last year, where Powell said one word, it was pain, households would feel pain, businesses would feel pain, the market nonstop sold for days and days and days. And Tesla was not immune to that. And of course, it was hit like a kind of a double whammy some weeks later when the Twitter purchase was going down, and it was just the Twitter overhang became a super overhang. It was not lifted at all. But so this is what could cause volatility as the week progresses. And there's another little bit of information that what we really need to look out again. I've been really harping about it over the past couple of days, and that is going to be the Chinese market, especially the Asian markets, could be a big catalyst to the downside or to the upside. Now, in this article, this is talking about from Market Watch. It says global investors expect China to deliver a massive fiscal stimulus. Here's why it may never arrive. Now, let's be fair. The media has been calling for a Chinese stimulus for months now, and this is maybe even since the beginning of this year, and nothing really hard has come through other than a very minor interest rate cut and some supportive elements for the property sector. But it's really an issue of confidence. What really needs to happen is they need to, and as this article states, they really need to inject money into the pockets of individual people. So it's in this highlighted area, it says the government's focus on property stimulus is not working because households have lost confidence in property, and no stimulus will change that. And I think that's rather true. The stimulus is pushing on a string. In the next highlighted section, it says the government can support can supply the credit, you can tell banks to lend. But if companies are unwilling to borrow because they're not confident enough to invest and expand, then your stimulus hits the wall. And that's very, very true. The article goes on to talk about, would this be China's 2008 great financial crisis? You guys remember, if you're an American person, back in our day, 2008, everyone around the world was blaming us for the whole mortgage-backed security thing and ruining the market and destroying housing prices all across the world. But this kind of debt-laden economy that is China, who isn't growing, who had an overheated property market that is crashing severely, who doesn't have any safe way to invest in a person can't really invest for their future because the securities market is just so volatile. The real estate the real estate trusts that they're investing in are completely worthless. The companies themselves a lot of these companies are on the brink of bankruptcy, and the Chinese government is doing everything they can not to and just inject cash into the pocket of individual consumers, but they kind of really need to, because they are in deflation, and they are in a consumer deflation, and they are just like this article says, the local governments are in debt. They have no money. They can't prop it up. The top priority for policymakers needs to be stimulating household consumption, and it is necessary to use all reasonable, legally compliant, and economic channels to put money in the residents' pockets. Kai Fang, a member of the Monetary Policy Committee at the People's Bank of China, said in an article posted late Monday. Earlier this year, Kai said a direct stimulus of $551 billion paid directly to Chinese households is an option to spur a recovery in consumer spending. China's consumer sector fell into deflation in last month of July. For the first time in 2 years, the consumer price index dropped 0.3% year on year last month. They are in deflation. So over the weekend, and there's people saying, okay, this is going to be the time that the stimulus comes through. It's going to happen this weekend. So by Monday, when the market's open and when the Chinese market's open, they're not going to keep falling over and over again, in which they're basically doing. They're just crashing over every day. And the Hong Kong index actually entered a bear market, I believe, yesterday. So the idea of a Chinese recovery with the exuberance from early this year, that was completely unfounded, and it took a long to unwind, but we're back to square one with the Chinese market. The catalyst for that is that the Chinese market stimulus, if it ever happens, would be really great for Tesla. Chinese market is a very strong market, and if these people will have the confidence to take loans out and because their interest rates are lower than ours, take loans out and buy cars, perfect for us, perfect for the economy. And really, this is something that is a catalyst for the whole market that Tesla would outsize benefit from. We can talk about the Cybertruck release and the Model 3 Highland all we want to, but the major macroeconomic factors are what's holding Tesla back in the short term, in the next couple of days, more so than all these other things. Okay, let's say the Cybertruck is released tomorrow, and let's say Tesla goes up 5% in one day. Trust me, it would literally sell off within 2 days from that little bit of news, and just follow the market to wherever the market is going. You kind of need the macro to look better, because the macro is driving rates up way too much on our treasuries. The risk-free rate is going up and up, meaning that people would rather be in those risk-free assets than be in something very, very volatile, where Tesla, you can lose 28% of your value of your equity within less than a month's time, right? So let's look at some data about how bad is the sell-offs, right? How bad is the sell-off? Here's a little article compiling some little pieces of data for what this drawdown has become. So Tesla close. This will be the lowest close since the 2nd of June, when it closed at $213.97. Of course, we didn't close that at $213, under $213.97, but during the day we did see like a high $212. We're currently down 10 the last 11 days. We're currently down 6 consecutive days, 12.6% over this period. This is the longest losing streak, since December 27, 2022, when it fell for 7 straight trading days. This is the worst 6-day stretch in performance since April, when in April it fell 16.5% in those 6 days. We are down almost 20% just from the month to date. This is not including the end of July, where we had that big drawdown. Yes, we are up 674% year to date, but that kind of just lines up with a really harsh sell-off that we had into the beginning of the year. So that kind of made it look better than what it really sounds like. People saying, "Oh, for year to date, you're up big," but I'm like, number one, not everyone was buying then, and number two, it just happened to coincide with the bottoming of a really harsh drawdown at the end of last year. We are down as from the overall all-time high of 409.97. That was a close. I think we saw probably 414. We're down 47.7% from that. Just to let you guys know, like just recently, we had new highs from like Nvidia, Apple, Microsoft, and Tesla's down like 50% from its all-time high. That's not a great look. We are down still from 52 weeks back. From August 19th, 2022, we were at $296.67, or basically the same price we were at right before earnings was released a couple weeks ago. We are down 30.6% from the 52-week closing high, which was in last year at 309, and we're up 98.3% from its 52-week closing low of January this year at $108.10. We traded as low as $213. I think we saw lower than that, where we saw high 212s. So it's not a good look, but how does this really compare to historical price action? Let's take a look at that. So let's go back to the charts for Tesla. And I kind of look back, and you can, first of all, let's just take a look so you can kind of visualize what's going on here. So they went on to say that for the past 6 days, okay, we've been red. And you can see that here, 6 red candles. Makes sense. We had one very meager green day to break up that drawdown. And then we had another 4 days of red. And so we'll just mark that with a slightly different color. And the reason for that is I looked through our charts to try to find similar drawdowns where we had like 10, 11 days of a drawdown in red broken up by just one green day. And it was actually pretty difficult just to find even 5 days in a row that were red. There was one here, of course, we talked about April. There was a drawdown in April. And we need to keep looking until the Twitter fiasco last year, where there was a drawdown of about 1, 2, 3, 4, 5, 6, 7. So there's 7 days in a row for Tesla going down. And one green day and 3 more red days. So that's, 11 days with one green day. Something similar to our situation. So it kind of begs the question, we know why it was falling from, we know why it fell from Jackson Hole. We know why it fell from the purchase of Twitter. And you probably start saying to yourself, but what is going on here? It's our earnings, we beat on earnings. We beat on the top and bottom line. So why are we experiencing a sell-off just over and over and over, where the likes of some other tickers are just not seeing the same thing? So we're down 27, 28%. And the indexes are down 4 to 6% or something like that. And something even as volatile as Nvidia. What is Nvidia's drawdown from its high? Oh man, we don't want to see this. Okay, so let's just humor ourselves, and so we can try to understand how much are we being punished for being Tesla. And Nvidia has seen a drawdown from a high to a close of 9.89%. What? Now, so Nvidia closed down 9.89%, which maybe makes sense. Maybe that's kind of like a beta of 1.8, 1.9 compared to the index for the NASDAQ. And we can familiarize yourself with the drawdown in the NASDAQ just so we can kind of, be fair. From the high to a close, 7.82%. It's not a great look, unfortunately, for Tesla, who is outperforming by margins that I just don't even understand. But the reality is because it's kind of getting hit from all sides, where it's being treated as an automotive company that are really sensitive to consumers not being able to afford interest rates. It's being sold off to de-risk for the AI bubble, quote unquote, and the margins. There's no guidance on margins in the future for auto gross margins. People hate Elon Musk, so they sell the stock or try to short it, and there's a lot that has to work against Tesla. And when it sells so violently that it's almost like this is a mature company who's selling millions of cars and doing it in a profitable way. But you're punished for maybe a personality of a CEO. You're punished for being associated with AI, but at the same time not being considered AI, because if Nvidia's AI and it's only down 9.8% and Tesla's down 27%, it feels unjustified. But if you try to look at it objectively, a lot of people are just not interested in what Elon has to say. They're not interested in the AI story of Tesla. People don't believe that FSD is going to ever release, and it's in a full release, like approved by regulatory bodies all over the world, to the point where, as we're selling off from Twitter for months, like that is when we find an equal drawdown. But it almost doesn't make sense, right? Because the situation is totally different. The earnings report was okay. But let's continue to see if we can find any other examples of at least a 5-day drawdown. We have a 5-day drawdown of October of last year, which was the bottom for many, many stocks. We had another drawdown for Jackson Hole of last year, which is really, really devastating. So you had 2 right here. Oh, there's another one. Yeah, so there's 2. So we'll highlight that. And this was a really severe drawdown for the entire market. So this was, if that's 12 trading days and 2 trading days were green. But still not as bad as what we're dealing with right now. And if you want to know what that drawdown was, this destroyed people's portfolios last year. But for Tesla, that was only a 13.6% drawdown compared to our current drawdown of 29%. So looking back here, even through these really sharp declines in the share of the share price for Tesla, not a 5-day losing streak there, not a 5-day losing streak here from the looks of it. Even from all-time highs, there's no 5-day losing streak. There's not a 10-day losing streak or 1 green out of 10 there. We have to go back to 2021 in March, where we had another 5-day losing streak, and we have to keep going back further to find another. We have 2 more in February and March of 2020, and we have another one in May of 2019, and you can kind of see here there was another 5 days before and after. So this is a very similar drawdown to what we're experiencing. Let's kind of measure it just for our own sake, and that was a 26% drawdown. So that was very, very similar, but just note that wasn't the bottom, and overall that was a very large drawdown from a recent high. That would have been I'm sorry, let's use that measuring tool, not the rectangle. That drawdown would have been 53%. And that in itself is only 26. So there was a couple 5-day drawdowns in a row. And this one was actually a 6-day, 7-day drawdown in 18. And then you find another one in 18. So it's actually pretty rare. We have to go back 4 or 5 years to find a bunch more. So this is, you can tell that as violent as Tesla can be when it comes to consecutive drawdowns, and it is, the last year has been really, really tough for Tesla. And yeah, we're still so far off from the highs. We're not making any notable new highs in larger time frames. And so yes, we've sold a lot, and if we were to close red on Monday, that would be another historic drawdown in Tesla. And if someone asked you, like, explain to me why Tesla is down 30 something percent, if it goes down on Monday, explain to me why Tesla's down 30%, when the market is down maybe 7-8%. Volatile names like Nvidia are down only 10%, and Tesla is still selling off to the point where it's breaking records for the number of consecutive days being red, the number of consecutive days with only 1 green day in a row. So not a great look if we're red on Monday. I do like the buying after hours on after hours today, which was around 218 and what $218.70, something like that. But yeah, so the message is this a Tesla situation? Like a lot of it has to be with Tesla, the sentiment that goes with Tesla and its CEO, our Elon Musk guy, because yeah, I think we can look at the yields and we can look at yields and say to ourselves like, oh yeah, I mean yields are very high. We're closing at over 4.25 on the 10-year, right? And when yields are going up, stocks would sell. But are they supposed to sell 30%? They're not supposed to sell 30%. Even long bonds, they're what? This is the 30-year at 4.379%. It's really rivaling still the highs from last year. So we understand from the market's perspective that there's a lot of de-risking going on, selling of the tech stocks, getting ready for Jackson Hole this Friday. I don't think people really want to be holding too much. I think people are really shocked what the Jackson Hole of 2022 did to them, because if you listen to like YouTubers, and like it wasn't that big of a deal, but it is now in our psyche. It is now, right? Okay, so I do want to go back to the browser just to kind of familiarize yourselves, you guys, with kind of the price action for Tesla. Here's the Max Payne site, and looking at the volume. You can see there's, for the 215 strike put, there's 425,000 puts in the system, and the calls are around 342,000 at the $217.50 strike for the call. So it opened in this way where there were more puts at 215 and less calls at 217, but these spikes were the highest of interest, and so I made a tweet this morning saying like, hey, like you guys need to kind of just, look at, what did I say exactly? Oh yeah. Okay. So the tweet was, be careful on OpEx Friday, Tesla fans. Sometimes it's a consolidation for a later day move. VIX can crush, which it does, and stocks can still sell and stay red. So be wary of that. Watch option chains for around $215 put and $217.50 call for Tesla options expiring today, because that is how the price action is going to be determined, and we're exactly right. So that stayed relevant the entire day. Those calls and those puts were relevant the entire day. And you can I don't really look at the open interest. That's not really relevant to me. The volume always seems to be much more accurate. And you can kind of look at another bit of information I want you guys to understand going into next week. That this is a pivot point for the market. Now we don't necessarily really track the market too much, and we know that Tesla's already through a valley of the volume profile. We talked about that yesterday, but now the S&P 500. So TrendSpider on Twitter had this great image that now that the indexes hasn't sold off as much as Tesla, so they're just now threatening their volume profile, and you're seeing it right there. This is going to have to be a make or break week for the market, guys. So when Monday starts, and let's say Monday's really green, you just have to kind of keep in mind, like, is that your entry for your hedges? If Monday is green, is that my only green day before I de-risk for the rest of the week? The market's on a knife's edge right now. That, yeah, it's been 3 weeks. Okay, these are weekly candles. It's been 3 weeks of red, and that's maybe pretty healthy for the market, because it's gone up a lot, I guess, in relative terms. And so maybe this is the moment where, okay, you can get a bounce because like I said, you're on that shelf of that volume profile on the S&P 500, or this could be falling through really quickly because whatever happens during the course of the week, be it China on the weekend, be it next Friday's Jackson Hole speech from our friend Jerome Powell. But looking at the chart, we do know that 3 red weeks doesn't really mean that much. It's been done before. It's been four weeks in a row. It's been 3 weeks in a row plenty of times, and it can be 5 weeks in a row if it really needs to be. So things can be oversold, and the RSI on the S&P 500 is very bleak, just like Tesla's. And we can take a look at that. Let's go over to the chart for the SPY, go to the daily, and the RSI is reading 35.28, and you don't really see something like that until last year around. Okay, it's actually, never mind. March, the bottom of them for March sees a very similar RSI around 35, and then you see another 35 somewhere around September of last year for the S&P 500. So just kind of keep that in mind that, yeah, I mean, we know Tesla's oversold, but the market is getting kind of oversold as well. And so we start to wonder, when will the MACD start curling around? You can start seeing that develop on Monday. On Monday, if it's green, maybe you see the charts kind of develop into something a little bit more bullish. But just note that when you get those really nice days next week that we're not out of the woods yet, we've shown you that, okay, yeah, I mean, Tesla can sell off pretty quick and pretty severely, but we do know that a 29% move down would not be historic, and by percentage terms doesn't necessarily mean it's a bottom. Just to remind ourselves, we are, we're below moving averages. Okay, we are finding ourselves coming into more of a volume profile, but you really don't see that until like the 190s in share price when you get into the middle of the consolidation for the spring of last year. I'm sorry, spring of this year. And before we depart, let's take a look. Let me turn off the moving averages. Let's take a look at targets. Of course, we know that if we were to sell on Monday, that maybe we find a base on this green area. Maybe we bounce even a little bit during the course of the day. But if we were to sell off, maybe by the middle of the week, we can be around maybe 207 by Tuesday, something like that. More of a downside target, which would be what a lot of people are thinking for due to the gaps and stuff like that are below. You maybe see the 193 area, this blue line, to the 192 area if you're going for the fill. And after that, probably in the 170s. So depending on how the IV, it's weird, because Tesla is selling off a lot, but some of the options are relatively cheap. Like the IV is crushing on Tesla, while Tesla's share price is falling, making it pretty problematic because, as you know, if you're selling calls like I am, you're not getting a lot of premium for that. Those calls are not really protecting you like you might be used to. So that's what kind of sucks. So puts are a little bit better sometimes because, the puts are actually kind of cheap right now. And that's in just relative terms, considering the situation, considering we're drawing down so much and IV is still crushing on Tesla. And I mean, overall, the VIX crushed again as well today. That's pretty typical for Fridays, quote unquote, VIX crush Fridays. So if you see a nice day on Monday, just kind of think to yourself like, hey, maybe I'm not hedged enough for the next week or so. Maybe I buy a put expiring, maybe the week after this coming Friday, or maybe as the week progresses, I'm going to start kind of scaling into something to protect myself from some type of black swan event, from the Jackson Hole meeting, or if you're coming in on, I'm not going to have a video out this weekend, but if you're coming into Monday and some news broke from the Asian markets, or if you're reading like CNBC and you just heard that, okay, the Chinese market is stimulating, then you might see a green day for Tesla. If you're seeing that another, big corporate entity in China is filing for bankruptcy, that could send share price falling for all the global market. So that could be a problematic thing. But this is why reading and watching the news can be really, really helpful when you're trying to track your next move for Tesla. But yeah, guys, like I know it's been bad. Like there's really no way to put it because you can explain it. You can tell yourself it's the yields. The yields are going up. I mean, like I get it, but 28%, 29% drawdown after a beat on the earnings report, after a record production and sales and deliveries, and you're down to $215 a share from 290 something, not but 1 month ago, after an earnings beat. It's a tough pill to swallow. But if you've been with me for the past couple of weeks, We've been talking about hedging constantly and over, just hedging, because we know that when Tesla gets into these like this momentum, it's really difficult to stop because number one, you're not getting great news out of Tesla themselves. Elon is not talking enough about Tesla. There's nothing coming from the team at Tesla to really like calm down the people that are investing or trading this stock, and it just creates more incentive to sell. That's where the trend is going. It's going down, and if we start moving our way back up, just know that a base might take a couple days to form, but it still will be really vulnerable from timing for Friday's speech from Jerome Powell. All right, guys, have a good weekend. Take care, and I wish all of us luck coming next week. Bye.